So as Daniel said, I'm Ovie Koloko. I'm Global Head of Product Development for ICAP Data and Analytics. ICAP, for those who don't know who the business is or what we do, is the world's leading interdealer broker. We operate in over 86 different countries, executing trades on behalf of sell-side, buy-side, and financial and corporate institutions as well, across both financial, commodity, and commodity markets. The Data and Analytics division, where I sit, is a leading provider of independent, impartial pricing information across, again, OTC, financial, and commodity markets, and our data is relied upon by customers in over 50 different countries. We've always prided ourselves in our side of the business on being able to provide a very comprehensive offering across the OTC data space, and by essentially being able to mirror all of it, by being able to provide data services which mirror the execution capabilities which we have in our core business. And that's represented by the various different asset classes which you see there. Within data and analytics, we're a content owner. The data that we provide to our clients is our content. It's generated either directly from transactions that we see across our execution venues, or off the back of analytical processes which we've built within the data and analytics department, specifically for the purpose of delivering content to our customers. We're an analytics developer, and we've been able to develop internal statistical processes, both in terms of supervised and using unsupervised econometric processes in order to generate consistent data sets. And we've also been able to deploy technology externally to some of our customers as well. And we're critically important. Our data is relied upon throughout the financial services industry, and that's everything from providing content to national competent authorities for use in critical benchmarks, to providing data which can be used to calibrate margin models at some of the world's largest exchanges, and also providing data essentially which drives most of the Excel sheets on any junior trader's desk across the globe. I always say I don't always say to people, I've practiced this speech a couple of times over the last couple of days with both my wife and some of my friends, and they seem to be the only people who don't understand how important we are or understand what I do on a day-to-day basis. But I'm here today and looking forward to having an open discussion with you guys. Essentially, I think I was slated down to discuss changes in the dynamics within OTC liquidity. But I actually thought it would be a bit more interesting just to discuss some of the challenges that we're seeing within our industry at this point in time, both on the sell side and on the buy side, and then look at some of the ways in which we at ICAP Data and Analytics are trying to reconfigure some of the content that we have in order to provide our clients with some more effective solutions. So following on from the bad jokes, is that going forward? We've recently just come through the Q1 reporting season, and there's been much made in the press about the difficult environment that sell-side organisations are currently facing. You can see here from the chart some of this, and I'll go into a bit more detail about that shortly. But the position that both my division and our overarching firm has within the market sector means that we're able to feel this and see some of these challenges right at the coalface. As a capital markets infrastructure provider, our clients expect us to be able to provide solutions to them which ultimately mitigate some of these challenges. And for us, that typically means developing products that facilitate both the speed and ease of transacting and at the lowest possible execution cost. Where am I? In some of our core derivative markets, where ICAP Data and Analytics historically has been the content provider of choice for both risk and pricing related data, the market is coming under particular threat, and there are some very large challenges in which people are facing. And so today what I'm hoping to be able to discuss is some of the structural challenges that there are, but also look at some of the tactical immediate challenges that are faced in the market, and it's with the tactical challenges where I feel that we're able to provide certain solutions. So from a structural perspective, essentially we're in a very low, sell-side institutions and buy-side institutions, the traditional institutional and active asset managers are in a very challenging low growth environment. Fee pools are obviously contracting across the piece, and you can see by the chart there, looking at both FIC trading and equity trading, sales and trading from the 16 largest banks over 2017 and 2018. But there's been minimal growth, especially in some of the core markets where people are transacting. Added to this is that there's a significant amount of technological change taking place in the market. And we've heard from some of the conversations today that both in terms of new fintech providers, but also internal changes which are taking place within the sector, is creating a very challenging environment for which people work in. Sales and trading businesses across both EMEA, North America, and APAC have seen contracting fee pools over the last year due to things such as MiFID II, the pressures, as I've described there, on the asset management industry, with firms moving away from the traditional active management towards lower cost passive investment vehicles, and then the continued volatility dampener that we're seeing, both caused as a consequence of the slowdown in interest rate increases in the US, and then the continuation of quantitative easing here in our home markets in Europe. When you add to that some of the trade policies that we're seeing come out of the US from our friend in the White House, and as we saw overnight, and then some of the other issues that I'm having to deal with on a daily basis in terms of Brexit in the UK, you can understand that it's a very difficult market and a very difficult terrain for institutions to traverse. The second issue that firms are going through is that certain support functions which were built up in response to the financial crisis 10 to 15 years ago are in need of being either reassessed or at least on the minimum streamlined in order to match and to be more in line with some of the changes which are taking place in the front office. Trade execution in most markets is already highly automated. And I think it's always interesting when we bring customers into our firm and they look across the various different desks at TP ICAP, they're always amazed at just how much electronic intermediation there is in some of our core in some of our core asset classes and across the piece. And that's for what's called a typical voice broker. However, many of the critical decision-making processes which lead up to a trade are in need of also becoming more automated. And one would expect that as that happens, there'd be an increase in balance sheet velocity, improvements in hedging capabilities, and more importantly, a reduction in the amount of risk which comes about or is generated off the back of human intervention and error. Redesigning, therefore, the risk and control functions which support that activity is a huge challenge, especially when many of the activities which are conducted at present are either duplicated or have responsibilities which are blurred due to multilateral regulatory lines. And again, we know from the interactions that we're having with firms at the moment that this is an extreme challenge, but one for which our firms and our customers are facing at the moment. The third area is actually in and around the viability wholesale of certain business asset classes. And we're engaging with and know that there are discussions taking place, especially here in Europe, in and around whether or not it makes sense to continue maintaining businesses which are chronically unprofitable for the pure case or for the pure sense of being able to offer franchise services across the piece to our clients. From a tactical perspective, some of the issues that our clients are facing in and around competition, especially here in European derivative and cash markets, and then regulatory challenges brought about by things such as MiFID II, and in particular things in and around the best execution regulation, where there's been a wholesale change in the dynamic between client and the service provider relationship, in that asset managers and client trading firms in themselves are putting far more emphasis in and around the price and putting far more prices into competition, as opposed to prioritizing other historically important factors. So for dealers, there may no longer be a payoff for them in terms of providing trade ideas and market color to clients, and then attempting to print lots of trades at mid-price in order to drive additional flow through their traditional businesses. And that's something that we're feeling downstream in our business, which then has implications on how and where we organize our data. The third tactical issue that people are facing is the continued contraction of bid-ask spreads. And again, we've been able to see this in some of the content that we have in our business. In core European rates and government bond markets, there's been a significant contraction over the last 18 months as a consequence of MiFID II. And in some ways, this demonstrates the success, I would say, in terms of the regulation. And I know that certain people today have discussed whether or not there have been certain unintended consequences of MiFID II. And one that we're seeing, obviously, is the challenge that firms face as markets become more transparent and as our customers start moving towards an environment where they focus more on generating direct revenue and direct value for their end customers as opposed to maintaining relationship. However, these fundamental shifts in market structure and client behaviour mean that firms with the weakest starting point are increasingly finding it difficult to catch up, and they're disadvantaged. And from the discussions that we're having with our clients, we know they're seeking ways to compete for balancing demand of defending themselves in their core markets with being able to find long-term profitable growth opportunities in the future. So what are some of the recommended remedies? In terms of front office reductions, I think this is something that we've seen historically. Our firms have become very adept at being able to squeeze an additional 5 or 10% of costs, squeeze an additional 5 or 10% in terms of cost gains based on short-term changes in terms of top-line growth. The extreme option for firms is obviously the wholesale exit from various different business lines. An assessment is obviously taking place at many organisations of which business activities are no longer strategically viable, and especially in an environment where scale is increasingly becoming the most important factor. And again, that's having a knock-down effect. We heard the talk from the panel discussion earlier today where we were discussing whether or not where the pressures in terms of content pricing was coming from. And our colleagues over at Infront describing the need for them in order to bulk up in terms of scale in order to manage the challenges which are coming from there. However, where we think that most activity is taking place and where the most likely move is towards is in terms of service provider optimization. And this is where we're seeing some of the most innovative work that firms are conducting at this point of time, and where they're able to make the most aggressive leaps forward, both in terms of changing their strategy to tap into both increased top-line and bottom-line growth. In particular, what we're seeing is trends in areas such as pre-trade capture analytics and the greater use of predictive analytics in order to model capital, balance sheet, and tax implications of a trade. At the point of trade, augmenting the use of things like streamlining requests for quotes and pre-trade negotiation processes. And after trade, being able to have real-time analysis of both trades, position management, and margin management across firms. And we've been actively involved with a number of different companies, both sell-side, buy-side, and service provider, who are seeking to provide solutions in that way in order to directly meet some of the challenges that our core customer base is facing at the moment. The trading model of the future, ultimately, will be underpinned by greater use of real-time analytics and producing automated prices which are then distributed via APIs. We believe that tailored trade ideas will be generated utilising vast internal and external sources of information about clients, and prices will be generated by machines which are able to better assess the impact of trades in a real-time fashion in order to enhance resource-allocated decisions. This automated setup will allow trades to be auto-affirmed and processed from front to back more effectively, and ultimately will lead to a massive enhancement in terms of the efficiencies that we're seeing in the marketplace. It's with these changes in mind that at TP ICAP that we're looking and we're trying to assess how we identify new methods to provide our clients with greater insights and new types of data. The traditional data sets that we provide will continue to be incredibly important. And this year alone, we've launched already this year 2 new services, one for ICAP Euro interest rate options and the other for ICAP inflation, both of which were driven by customer demand and the requirement for customers to receive data from us in a more systematic fashion directly into their business critical applications. We're also in the process of launching 2 new emerging market-focused offerings, one covering ICAP India, where we have a leading franchise via our Mumbai office, and another in Africa, where we're planning on launching a local currency-denominated African fixed income service. However, increasingly, what we're hearing from our clients is that the next generation of applications and services that they're building are increasingly going to rely on transactional data. And what we need to do is work towards a world where we can provide even more than we're currently able to from a regulatory perspective in as close to real time as possible. And we believe that delivering such content, both in raw and derived format, will allow our clients to gain better insight and derive even further value from the data that we're able to provide today. We hear much about the benefits of both artificial intelligence, machine learning, and big data analytics. However, there's less of a discussion in and around both the types and the format of data which is needed in order to drive the models that people are building. And we feel that there's an opportunity from our side of things to work closely with our customers in order to bring data sets which have traditionally been very closed to the markets in order for more and better systematic consumption. Key to this is the level of processing that we're able to do from a data and analytics perspective, and also the transformations that we make to our data prior to providing it to our customers in order to allow them to provide the tasks that are required either to make or save more revenue. The core function for an interdealer broker is about finding liquidity. And we do so by creating an environment which allows arm's length counterparties to coalesce in and around a price and volume discovery process. And as such, we provide the critical plumbing which allows securities in order to move around the financial services industry. At its most simplistic level, our clients are asking us to help them automate the activities which lead up to this process. And we're working at ways in which we can deliver and streamline our data in a way which allows them to do this in a more effective manner. Simply providing data is one thing, but doing so in a way in which an algorithm can make some sense of it and can infer value and infer and create value off the back of it is another thing. And that's the challenge that my team and our firm as a whole faces at the moment. So where do we feel that there are opportunities in and around our transactional data to do this? One of the areas which is most commonly spoken about is the area of offsetting. And offsetting client trades is one of the ways in which client information is recycled in and around the marketplace. Again, this is typically a process which has been carried out manually via desk and client communication. But we feel that with better data and delivered in a more automated fashion, we'll be able to give better insight to trading desks and who are able then to decide where next to place risk. And what we can see here is just net long and short positions within the corporate bond technology sector. Essentially, by being able to see how the net long and short position is changing over time, you can see within that sector where essentially the market feels risk is going and how that obviously is changing over a period of time. Trading book positioning is another area where we think there's an opportunity. Traders have always proved their worth by ensuring that their book is essentially positioned against negative market moves and then making money by ensuring that their book is aligned to positive market moves. And again, we feel that by being able to provide more and more volumes of trade information, we can provide traders with an opportunity to have a better understanding of which direction the market is going. Providing market colour is key to what we do. It's a basic function of what an interdealer broker is there to do. However, doing so again in a systematic fashion which allows an algorithm or a machine to read that information and then derive and create some value from it is very difficult. For many of our indicative pricing models that we've built on the TP ICAP data and analytics side, we've incorporated many of these ideas. So if you were to take any of our corporate bond pricing, we calibrate our models taking into account whether or not we think the market is either better bid or better offered. However, what we're starting to do now is reconfigure the way some of our analytics work in order to be able to provide that type of solution and that level of analytic to our customer, so that we're not just providing them with a raw data set, we're providing them with some additional analysis which allows them to process the data in a far more effective and an efficient manner, and then obviously to derive that value which they're looking for. The other area where we've been requested and we've been asked to provide content is in and around market flow information. So developing dashboards which would allow salespeople either at sell-side banks or execution traders, asset management and buy-side firms to start gaining a better understanding for where market flows are moving over a period of time in an aggregated fashion. Getting an idea of a changing view of an order book is something which is particularly important. And again, it's something which would have historically been done via voice communications. If we can simply look again across various different sectors, and I'm hoping, no, I don't, have this chart without the financial services sector improved in there, you'd be able to see how the dynamic and the risk is moving from one corporate bond sector to another, which is key information if you're looking to understand how you should position your book, or ultimately how your asset allocation model should look and work going forward. By being such a large liquidity provider and being the liquidity aggregator of choice, much of this information sits and resides within our organisation. And the difficult thing for us, and for my team in particular, is about being able, one, to gather that information and then transform it in a way in which we can present, rather than presenting this in a chart during a presentation, we can push through to our clients systematically, directly into the models which they're building. So, in conclusion, I know I've rattled through that relatively quickly. It's clear that 2019 is obviously going to be a challenging year, both for our customers and also for organisations such as ourselves. But we feel that there are a number of different avenues which could be explored by firms in order to defend both their core businesses, but also to help bolster and provide additional services within the new businesses that they're trying to build. At ICAP, we're working very closely with our customers to understand how we bring this content to market in the most effective way. And we're always open and looking forward to ideas that will come directly from you as to how exactly we go about doing that in the best way in the future. Thank you.